Hey everyone, my name is Nick Giles. I'm here with my lender, Mike Demke. We get a lot of questions on the current market right now. What the heck's going on? Is the market going to crash? Rates are keep going up. I'm not going to buy. I'm not going to sell. And so we thought it'd be good. Let's get a video out there. Let's talk about it, and let's subdue some of those fears that everyone's talking about. So I'll turn the time over to you.
All righty, that sounds good. I'm gonna go through a couple different things here, and I'm gonna share my screen here in a second. But I just wanted to kind of preface this. If we were able to predict the markets, we would all be not doing what we're doing. We'd be billionaires. So the only thing we can do is rely on a lot of statistical data, rely on certain trends that are happening right now to make the best predictions possible. I wanted to first start out, just show you the market trend and what it's done over the last 6 months to a year. And you can see, back in September of 2021, we've just continued to come down. This is, this huge downswing. In fact, since March of 2022, we've had a dramatic crash. And this is the bond market and what we're looking at. We're looking at the 30-year Treasury, and that's what we base mortgage rates at. And so when the bond market is down, like these charts show, interest rates go up. And so you can see right here, about a week ago, 10 days ago, we had a huge crash. These red candles that go down, we had a huge crash in the bond market, and interest rates peaked as high as they've been in a long, long time. And then you can see these green lines that go back up. And so what I want to talk about is the event that happened right here that caused this upswing. And what that event was, a week or so ago, everyone heard the announcement that the Feds were going to raise the interest rates, and they actually raised them by 0.75%. And so there's this misconception in the market that when interest rates are increased by the Feds, that mortgage rates go up as well, and they don't. And so I just wanted to show you that slide before I get into the affordability index here, and just let you know, we're going to explain that a little bit later as far as what makes mortgage rates go up and what makes mortgage rates go down, okay? So let's start off and let's talk about realistic numbers, because there's a lot of people out there that talk about this affordability between now and last year. And I just want to be very transparent on this and use realistic numbers, because these numbers are all over the board depending on who you're talking to. And so if you look at these numbers in 2021, the average home sale was about 400,000, and the interest rate was 3.5%. And so your monthly payment would be $1,796, okay? Now let's fast forward to this year, 2022. Prices have gone up on the homes. We've had some of the most historic increases in real estate, which has been awesome. Interest rates have gone up. We're about at a 6% right now. So there's about $1,000, $1,034 difference more than we're paying on our monthly payment than we were last year, okay? So there's no doubt that it's costing us more because prices have gone up and interest rates have gone up, okay? Now let's add in increase in wages. And so these are national numbers. The average increase is 8%. I believe in Arizona it's closer to 12%. But this is a nationwide number, okay? And so if we add the increase of 8% from last year to this year, we're making about $720 more a month than we were last year, based on national statistics. Okay, now people are going to say, well, what about inflation, all this other stuff? So we take that into account. We take household monthly expenses, we take the food, gasoline, service, we add that to the monthly payment. So we're really talking about $500 difference between last year and this year. So it's not as big of a jump as people think it is, when we're talking, okay? Now let's talk a little bit about existing home sales. Now that we know, this affordability thing, yes, we know it's costing us a little more, but the biggest questions that I get, and the most questions I get, what's happening in housing? Are we in a bubble? Is it going down? Are prices going up or down? Are interest rates going to go up or down over the next few years? What's going on? And so we look at these charts because we have historic data that we can go back and look at. So again, here's another chart. This is nationwide, month over month. These are closed sales. These are existing home sales, is down about 3.4%. Year over year, we're down about 8.6%. Prices continue to increase, and inventory's down 4 and 1%, which is we've known we've had these inventory issues, and there are a lot of reason why we're down on sales is over month and year over year is just because of the inventory shortage. Okay. This here, so in order to talk about what happens to the bond market and what happens to home prices and what happens to inflation, we need to look back in history. And I like to look at patterns because the patterns never lie. And we're going to take maybe a 50-year period back, okay? So back in the 70s, these were our federal chair guys. We had Burns and Volcker. And at that point, inflation was 7%, okay? And during their time periods, it went up to 14%. And people started panicking. We've just got this high inflation, what's going to happen? And so we look at mortgage rates. What did mortgage rates do? They went from 12% to 18%. Why? Because mortgage rates don't like inflation. When inflation goes up, the bond market doesn't like it. It tanks and rates go up to buy a house. And that's consistent over time, and it'll always be consistent. Okay, so when mortgage rates jump up to 18%, we have inflation up 14%. What can the feds do? And so what the feds do is they increase the prime rate. Okay, and that's what they did last week by 0.75%. Now the prime rate is what banks loan on things like credit cards, cars, TVs, appliances, whatever you want to buy. Okay, that's what the bank lends on. So when you look at prime rate, it's tied into home equity lines of credit and so forth. So when the feds increase the prime rate, what happens? Well, it slows the economy down. So inflation went from 14% down to 5%, lower than it was to begin with, okay? And this is back in the 70s. And so that's really important to know, because so when the feds last week raised the prime rate, what happened? The market's gotten better now 5 days in a row because it's slowing the inflation down. When the feds increase rates again in July, it's going to help even more. When they increase it in September, it's going to help even more. So what does that tell you? Over the next 3 or 4 months, we should see interest rates getting better just because of what the Fed's doing, okay? So mortgage rates, inflation lowered. Did somebody have a question?
Yeah, hey Mike, can I hop in real quick?
Yeah.
So basically what you're telling me is 100% the opposite of what everyone's believing from the news.
Absolutely. And I even hear it's misquoted so much on the news. In fact, I wanted to call Channel 10 the other night, and I wanted to call KTAR because you continue to get a lot of people playing on fear, okay? And a lot of people market based on fear. Hurry and get in, hurry and buy a house because interest rates are going up. Before they increase rates again, you got to get into your house because they're going to go up, and they play on people's fear. Well, that's not true, because once they increase rates, it's to help inflation, and the bond market is going to do better, and mortgage rates are going to go down. Okay. There is one caveat to that, and I'm going to show you here on a slide. But to answer your question, Nick, yeah, that's a big misnomer that people believe. When the Fed raises interest rates, that means mortgage rates are going to go up as well. And it's not always the case.
Well, and there's so much fear right now with buyers, especially buyers. There's a lot more sellers trying to get their houses sold right now in this current market, but buyers right now they're all holding off. They're all slowing down because they think interest rates are going to go 8-9%, and so they think the market's going to crash, which we're seeing here.
Well, and that's one of the reasons why we wanted to present this information, because I'm going to show you a correlation between three different things here. Okay, and so one of them is this history here. You know, inflation gets better, mortgage rates respond, they go from an 18 to a 12. But what is the consequence of this? Recession. Okay, Standard & Poor's down 30%, we hit a recession. So the definition of a recession is that we have 2 consecutive quarters where the GDP is in the negative. So in Q1, we had a slowdown, GDP was in the negative. We're ending Q2 now in 2 days, 3 days, and it's already predicted we're going to have it be in a negative. So technically, based on the definition of a recession, we will be in a recession by Friday, by all means, okay? Let's look at Alan Greenspan. In the 80s, we went from inflation to 1.75 to 3.5. Mortgage rates went up. This is actually the 90s. And then we had the rate fund. You know, they raised the rates 4.75 to 6.5. What happened to inflation? It dropped to 1%. What happened to mortgage rates? They dropped down to 5.5. What was the consequence? Standard & Poor's lost 50% of the market. We hit a recession. Let's go to Jerome Powell. And by the way, not one of these federal chair people will ever admit that we're headed for a recession. Never have I ever heard them say that we're headed for a recession. It's against their ethics to admit it, but we are. You know, finally, Jerome Powell's figuring it out, and he's starting to soften his stance, but he's still afraid to admit we're headed for a recession. But in the 2000s, we had an inflation go up to 8.5%. This is just recently. This is March. We hit 8.5 in March, and mortgage rates went up to 5%. We're actually up to 6%. The funds in March, they had only increased by 3%, but we now have the numbers in for June, which they increased it another 0.75%. And what did we see? We saw 5 days of declines in rate. Okay. Standard & Poor's is at the lowest I heard that they've been, the biggest losses in 40 years. What is the consequence going to be of what we're in now? It's going to be another recession. So I wanted to point that out, okay? Do we have any questions regarding that yet, Nick?
Not right now.
Are we good?
But people,
okay, so
feel free to ask them. Go ask all the questions you want.
So here's what I want you to understand on that slide. When inflation gets high, mortgage rates go up. Mortgage rates don't like inflation. When the Fed raises the prime rate, it's to help slow down the economy, and it helps to lower inflation. When that happens, the bond market does better and mortgage rates get better, okay? So we can see this. If you look on this chart, Fed hikes the rate, mortgage rates go down. Fed hike the rates, mortgage rates go down. Hike rates, mortgage rates go down. Hike rates, mortgage rates go down. Now here's the caveat, and this is what I wanted to bring, because if it was just a case of raising the rate, I could tell you confidently that mortgage rates are going to be lower in the next 6 months, because they're already planning on these rate hikes. But the trade-off to that is occasionally the Feds will come in and they're going to say, okay, we're going to have a runoff of how many bonds that we're buying in the market. In fact, we're going to sell off some of our bonds. And when they do a runoff or a sell-off of their mortgage bond interest, rates go up. Okay, so here's where we had, at this point in time in the graph, we had a sell-off. Rates went up, but then they raised the rate, went down, and we're back down here. So a sell-off can have a negative impact to that. So I just wanted to point that out, because we don't have a crystal ball of what the Feds can do, but they certainly can manipulate rates however they want. they can choose whether mortgage rates get higher or lower. They can do it in just a decision. Jerome Powell can come out and just make an announcement, we're going to raise the interest rates 0.75% in September, and the bond market will get better. And they don't even have to do it. Whether they do it or not, it gets better. Or he can make an announcement that we're going to sell off our securities, and the market's going to tank. So it's all based on news. Okay. Let's talk a little bit about inventory. So you kind of understand what happening with rates. And so my prediction on rates is that over the next 6 months, we're going to continue to see this inflation come down, because the government's slowing the economy down. They're raising rates again in July, and they're raising rates again in September. So unless they have a big runoff, we should see mortgage rates come down. So if I'm advising my kids to what's happening in the market, I'm going to tell them, look, and we'll talk about strategies here in a second. I'm going to tell them, look, mortgage rates should be better by next year than they are today. Okay. Now, inventory problem. So this was in 2008. So if you see the peak inventory, when we had the housing bubble and all those homes went back to foreclosure, we had hundreds and hundreds of thousands of homes throughout America sitting vacant, owned by banks, up for sale. So we had this huge inventory in 2008. Currently, we're at the lowest level we've ever been as a nation in inventory, and these are nationwide. And to make things worse, look at what the household numbers were. In 2008, we were at 116 million households. Now we're at 129. So we're at 15 million more households needing homes with the lowest inventory level ever. So if somebody's going to ask me, and Nick, you may chime in on this because it's more of the real estate side, what happens to home prices when there's a shortage of inventory?
They go crazy high, as we've seen the last 3 years.
Right. And so we've seen even back in February of this year, we were getting multiple offers on every listing that came up, and people were paying 50 to 100,000 above listing just to get the house. It got so bad. You'd have 5 or 6 people battling on every house the moment it went on the market. And so if somebody asked me, and I'm going to prove this and probably show you in 2 or 3 different statistics, but the first statistic I want you to understand, when there's a shortage of inventory, which means we have fewer houses than the demand for those houses, prices will continue to go up. That's what we call a seller's market. Okay. Until those inventory normalizes, then home values won't normalize. Nick, do you know about where we're at on inventory right now?
This morning when I looked, we were at, I believe, 14,000 active and coming soon listings on the MLS right now.
And that's in Maricopa County.
That's in Maricopa County. 2 months ago, we were at 5,000.
Because I know on one of the statistics, I might have it on a slide here, average days on the market is like 16 days on the market still. And what did you say like a normal market is?
A normal buy-sell, or a normal market, not a buyer's, not a seller's, it's 5 months that it's supposed to sit on the market.
Right. So we're like 2 months worth of inventory.
Yeah. So right now, we're about 2 months worth of inventory. We're a little over a month right now. But as my team can see, literally within 2 months, we've doubled our listing inventory on the MLS. Our listings, with all the proper marketing, proper pricing, are taking, more than a weekend to sell. It's still, less than 2 weeks, which is fantastic. That's still 100% a seller's market, and you're still getting a fantastic price. It's just taking a little bit longer.
Okay. All right. So back to the recession. So I don't listen to, there's a lot of different analyzers out there of the market, but this statistic over the last 50 years has been 100% correct. Anytime we have an inversion, which means the 10-year yield note drops below the 2-year treasury note, which means normally your long-term investment should pay more money than your short-term investment. But in this case, the 2-year pays more than the 10-year. So why wouldn't you buy the 2-year? You make more money in a shorter period of time. Well, every time there's this inversion, which means the 10-year drops below the 2-year, we have a recession. So these big white lines are recessions in the time period that we had the recession. So we had one in early 80. We had another one in the 90s. We had another one in the early 2000s. We had the big recession in 2008, which was the housing bubble, which is a different type of recession, and we'll talk about that. And then we had a little tiny recession in 2020 at the time of the election. But right now, I don't know if you can see it, but right here, there's a little tiny red line. And that's what I meant by we had this inversion that happened at the beginning of Q1, which is still going on, which means we're going to have a recession right after this at some point within the next year. Whoops. I didn't mean to do that. Let me find out where I was going. All righty. Now, let's talk about what happens in a recession, okay? So what happens to mortgage rates within a recession? We know we're going to have a recession just based on inflation, based on the GDP, based on the inversion that's happening with the 10-year and the 2-year yield. So what people ask me, well, what do mortgage rates do during a recession? Well, let's look at the last 50 years. In the 1980s, mortgage dropped drastically during the recession. In 82, again, mortgage rates dropped drastically. In 1992, drastically. In 2002, dropped. In 2008, dropped. In 2020, dropped. 100% of the time, mortgage rates have dropped during a recession. So again, I'm going to go back. If we're headed for a recession, we can expect mortgage rates to be lower than they are today, okay? So what happens to housing prices during a recession? We know what happens to mortgage rates, but what do housing prices? And so I'm sure, Nick, you've got a lot of people saying, hey, I'm not going to buy now. I think we're at the peak of our market and houses are just going to crumble in price. And I don't want to lose my shorts like back in 2008, you know? And I get that all the time. People are just, okay, we missed it. We didn't sell, you know, I'll wait till housing prices become more affordable, okay?
They're all waiting for it to bottom out.
Right, we're waiting for it to bottom out. So if we know we're going to be in a recession the next year, maybe 2 years, depending on the policy, what's going to happen to prices of houses? Well, let's take a look. In the 60s, they went up. 70s, they went up. 75, they went up. 80s, they went up. 90s, they went up. 2000, home values went up. 2008, you cannot count because that was the housing bubble. No one had equity in their homes. They had inflated prices and everybody dumped it. So prices went down because of the housing bubble. So that's an exception. In 2020, housing prices have gone up. So again, 100% of the time during a recession, housing stays strong, housing prices go up, we have low inventory. So I can say with confidence, look, this next year or two is going to be a good year to buy and get into a house because of where we're at economically, okay? So I hope that explains things a little bit better. I put this slide in here because I like to hear what other things out there on the internet, other you know, economists and what their feelings are. So Zillow did an interview with the top 114 U.S. economists, and they did this survey, and they asked, okay,
Did you say that again?
Whoops, that was my Apple Watch. Anyway, they asked, what do you think home prices are going to do over the next 5 years? Okay, and through their study, they or through this 114 top U.S. economists that were surveyed, they said over the next year, we should see a 4.8% gain. And this is nationwide. Now, in certain places, that's probably right. In Arizona, we're probably looking at another 12% gain, double digits. So over the next 5 years, we can be looking at a 26 to 30% gain in property values, okay? So that's these top economists. They feel like right now, we're not at the top. Home prices will continue to rise, okay? Now, they're going to become a little more affordable because we expect interest rates to go down. So your cost of owning one of these more expensive homes is probably going to wash out with the interest rate dropping as well, okay? Then the second question they asked them was about the risk outlook. So they asked, okay, out of the 114 top economists, who thinks it's just only upside? And so 14% say, yeah, we look at the next 5 years as it'll all be upside. 30%, 29.3 said they were kind of neutral, balanced. There's going to be some upside, but there's some downside. 56% said, yeah, there's going to be some downside over the next 5 years. So these are just interesting statistics that I look at. They asked, do you think we're in a housing bubble? 65% said no. Can the feds achieve a soft landing? I mean, can they figure this out to where they're raising rates to be able to shorten this this recession that's coming? 71% believe yes. And then they asked, do you think we've reached the peak inflation? You know, so over 50%, almost 60% said no, they feel inflation numbers will continue to go up. So that's interesting statistics from these economists. It's certainly in line with what we're talking about tonight. This is just a slide on new home sales. New home sales makes up about 10% of the new homes or the homes sold per year. And month over month, they're up 10.7%. A lot of that has to do with supply chain issues. We're just starting to get more building materials. So I think the new home builders could build a lot more if there was material. Pending home sales. So in May, we're up, you know, so pending home sales month over month is up 0.7. Year over year, we're down just because of the inventory shortage. But if people think May was our biggest month where everybody started panicking and rates were going up and inflation was going up, yet it ended up being a very good month, you know, for home sales. Certainly supports a strong home market, okay? This here is just an inventory chart, you know, over the last, looks like January 2017, so about the last 5 years or so. But if you look at where we're at in inventory, this is May, inventory levels have increased quite a bit, but that's normal. Nick, wouldn't you say in market, I know in real estate when I was in there, January, February is pretty slow, but come April, May, everybody's listing their home for the summer. Is that still the same?
You're exactly right. And then typically, at least here in Arizona, you know, June through part of July, it slows down. Everyone's on vacation. And so.
All right. So that's kind of what I have. You know, if I could, you know, sit and advise my daughter, and I always use this, if I were telling my kids or one of my kids something, you know, I had my daughter say to me the other day, man, this house that we bought was the best decision that we ever made. We're so lucky we did it. And they bought a house maybe back in December, I think it was. And I remember fighting with them saying the market's at the peak. We're going to lose on this. We're way overpaying. And they've got so much more equity in this house. You know, I said, I'm glad you finally just listened to me, right? And I would tell everybody the same thing right now. You know, if you're looking at selling your home or buying a home, the next 2 years is going to be a good opportunity to do that whenever you want. And so I know Nick and Sam, they have some tools that they use. We have tools that we use to help people get into homes. Or our goal, I think, as a team is to get you the most out of your house if you're selling and get you the best deal on the house that you're buying. I mean, that's always the game. And so we've got deals where we can buy the house that you're wanting to buy for cash and try and negotiate a better deal because it's a cash deal. We can do things like if you need to get the equity out of your house to sell it, we can buy your house that you're wanting to sell so you can free up equity to move. There's a lot of things. I think if you just want to reach out, we can probably figure something out, right, Nick?
Well, of course. So something that I have been told, all through 2020, 2021, even at the beginning of 2022, is there were so many people that were so scared to go buy because they had to sell their house. And they were like, we don't know where to go once we sell. The market has slowed down. You can still sell your house for a fantastic price, but then go get into something else, without competing against 20 other buyers. It's a lot easier now. And that seller's in the same position that you're going to be in when you're having to sell your house. And so it's cooling down.
We were talking this morning about it's changed so much that this is the first time I know I saw a deal on ours where we're actually seeing seller concessions coming back. You guys had a borrower that was able to put a house under contract with a contingency on them selling their house, which we haven't seen that in the last 4 or 5 months.
It's been very, very, very rare. About one a year, maybe two, but rare.
So, I mean, it's getting back to a little bit more of a buyer's market. It's still a seller's market, but there's deals out there that can be done. And I guess my message is look, if you're worried about buying a house and the value is going to go down, you're absolutely wrong. Over the next couple of years, your value is going to go up. So if you're wanting to upsize or move or get into it, it's not too late. There's time.
I agree with you, Mike. So I thank you for this. If anybody has questions, feel free to ask us. We'll send out a follow-up email so you have all of our contact information. Anything else you want to say, Mike?
Yeah, I wanted to make one other point because we do know that interest rates are up. And for every 1/8 of a point, depending on the loan amount, your payment's going to go up anywhere from $20 to $30 a month. I know interest rates are going to be lower in the next 6 months. And anybody that has a deal that wants to get in, and once interest rates have gone down where it makes sense to refinance, I will refinance you out of the loan we put you in with no lender costs and just completely streamline and get you back into that rate. So I wouldn't let rate bother you so much because if you do the math, you're only out maybe $400 or $500 in difference in house payment over that 6 months, and in the grand scheme of things, it's not really that big of a deal because there's going to come a time that we'll just refinance you right back into a better rate for long term.
Sounds great, Mike. And so once again, thank you everyone for coming. If you have questions, let us know. I'll email everybody a follow-up with my contact and Mike's. So thanks again.
All righty. We'll see you.